before we move on to trading indicators, I just want to say that the foundation of good trading is going to be how you are able to draw things on your chart. If you can draw support and resistance, great, that is fine. But the key is understanding the relationship between price and movement, supply and demand. I think a lot of traders make the mistake that they forget that price is just people transacting. You can see all these lovely charts, and yeah, the chart packages are great and they give us all the information we want. We've got all this computing power, we can do lots of things with it, but ultimately it is just people agreeing on price. And if we get back to that basic, it becomes easier to generate trade ideas. When we start to see that people are buying at highs, or they're selling at lows, or they're doing nothing, that's when we can say, have we got an edge as a trader? Can we make a good trade idea from this? Can we take some profit from the market? Rather than just looking solely at what the chart is saying, it's interpreting that into human transaction. And that's very, very important. That. Okay, so trading indicators. Now, there are strengths and weaknesses to indicators. I'm a big advocate of saying, listen, I've got a strategy, I've got a price pattern I like to look at. Let's say I want to look at a trend and I want to buy a pullback from the trend, and I'm going to use an indicator to help me make that trade, as opposed to just using the indicator as a complete guide and saying it's just a yes or no tool that's telling me when to trade. I prefer to use it as a filter and as a little bit of a guide as to when I'm going to execute the trade. And actually later on in the course, when we talk about this powerful trading strategy that I use, that does have an indicator in it, but again, we're using it in conjunction with a pattern that appears on the chart. So we're not relying solely on it. I think that's a big mistake that a lot of traders make. So let's look at some of the big ones, or some of the ones that I prefer to use. Moving averages, choosing a length, what it is, first of all, choosing a length and how we can use it in our trading. And we've got something called relative strength index, or RSI. How we use this, it's called an oscillating indicator, sorry. And stochastic, very similar to RSI, but the mistake that people make with this tool, I think if you understand this mistake, then you can avoid some of the horrible losing trades that people get sucked into. Bollinger Bands and Keltner channels, this is a great little tool for filtering out some losing trades and not getting caught in markets unnecessarily. Then I'm going to move to average true range, ATR, and this is a fantastic little tool for understanding the market's volatility, how you can use this to generate your stops, you can use it to get into trades or out of trades. And the big one that people tend to neglect is just volume, understanding the participants and using the right indicator for the right market. As I went back to the very early slides, trending market, range-bound markets, understanding the difference between the two. They're not the same. This is when indicators come into their own. You've got to use the right indicator for the right job, and understanding the strengths and weaknesses of an indicator. And before we look at some chart examples, guys, it's important to note that every single indicator is derived purely from price, maybe volume, maybe time. Everything that we see on our chart, an indicator is just doing that. Maybe it's taking an average, it's adding some sort of calculation to that raw data to give us an indicator value. So let's look at moving averages on a chart.